Tokyo, January 20th, 2026. Japanese 40-year government bond yields explode to 4.2%, the highest level since they were introduced in 2007. The 30-year yield surges 30 basis points in a single day to 3.9%. The most violent move since records began. Traders at PIMCO describe it as the most chaotic trading day in years. Tokyo, January 4th, 1990. The Nikkei stock index hits 38,921, an all-time high. Real estate in central Tokyo is valued at more than all the land in the entire United States. The Japanese economy is unstoppable. By year's end, the Nikkei has crashed 43%. By 1992, it's down 63%. Trillions of dollars evaporate. The lost decades begin. Edo, what we now call Tokyo, the year 1716. Shogun Tokugawa Yoshimune takes power facing a catastrophic debt crisis. The government is broke. Samurai are starving. The currency has been debased so many times that inflation is destroying the economy. His solution: raise taxes to 50% of peasant income. Debase the currency more. Borrow massive amounts from merchants and never pay it back. What if I told you these three moments aren't separate crises? What if they're the same crisis, repeating every generation? What if Japan has been trapped in an economic death spiral for 300 years, and the final collapse is happening right now? Let me take you back to where this pattern began. The year is 1716. The Tokugawa Shogunate has ruled Japan for over 100 years. The Edo period, an era of peace, prosperity, and isolation from the outside world. But beneath the surface, something is rotting. The government is drowning in debt. Samurai, the warrior class that forms the backbone of society, are being paid fixed salaries in rice. But the economy is changing. Cities are booming. A cash economy is emerging. Merchants are getting rich. But samurai income stays frozen. By 1716, when Shogun Tokugawa Yoshimune takes power, the government faces a choice that will sound terrifyingly familiar. Do we cut spending? Reform the system? Or do we just create more money? They chose option 3. Let me read you what actually happened. This is from historical records of the Tokugawa government. The Tokugawa Shogunate conducted recoinages, the Jinroku recoinage in 1695, the Hoi recoinage from 1706 to 1711, to debase gold and silver coins in order to increase the money in circulation and to improve the government's fiscal situation. Does that sound familiar? Increase money in circulation to improve fiscal situation? They were printing money. In 1695. Here's what happened next. And I want you to pay very close attention, because this pattern repeats exactly in 1990 and in 2026. First, currency debasement. The shogunate reduced the gold and silver content of coins. More coins, same amount of metal. Money supply increases. First, it works. The government can pay its debts. The economy seems to stabilize. Then inflation hits. Prices start rising. The new money floods the economy. Goods cost more. The common people suffer. Here's what happened. To cope with inflation caused by the Jinroku recoinage, another recoinage, the Shotoku recoinage, was carried out in 1714 to increase the gold fineness. They tried to reverse it, put more gold back in the coins, but it was too late. Then the trap closes. The Shotoku and Kyoho recoinages resulted in increased gold and silver fineness. This resulted in a sharp reduction of money in circulation, causing stagnancy in economic activities and a decline in commodity prices. Do you see it? They created inflation by printing money. Then they tried to fix it by reducing money supply. But that caused deflation and economic stagnation. They were trapped, and they never escaped. Blue, dark pink, maroon, golden, zinc, multi-dark purple. Fast forward to the 1830s. Japan is facing what historians call the tempo crises. Let me paint you a picture of what Japan looked like. Government debt is crushing. Daimyo feudal lords are bankrupt. The shogunate keeps debasing currency to pay debts. By the end of the Edo period, recoinages, bunsei and tempo recoinages were often carried out to finance the budget deficits of the shogunate government, which led to chronic inflation. Samurai are drowning in debt to merchants they theoretically outrank. The social order is inverting. The government forces wealthy merchants to loan money. Historical records show that wealthy merchants were often forced to lend money to the shogunate or daimyos, and this money was often never returned. Does this sound familiar? Government forcing creditors to lend? Chronic inflation from currency creation? Debt spiraling out of control? And here's the key detail that will blow your mind. By the 1830s, nearly 80% of the clans had issued hansatsu notes, local paper currencies, resulting in severe inflation. The country had fragmented into dozens of different currencies because the central government's money was worthless. This is what happens at the end of a debt crisis, when the currency loses all credibility. But here's what nobody talks about. Japan never actually solved this. They just reset the system in 1868 with the Meiji Restoration. The pattern was buried, not fixed, buried. And 122 years later, in 1990, it came roaring back. Japan, 1980s. The Japanese miracle. From the ashes of World War II, Japan has risen to become the world's second-largest economy. Japanese cars dominate global markets. Sony, Toyota, Mitsubishi, these brands are synonymous with quality and innovation. By 1989, Japan represents 42% of global stock market capitalization. Think about that. One country, 42% of the entire world's stock markets. Real estate prices in Tokyo are so insane that the Tokyo Imperial Palace grounds, just 1.15 square kilometers, are worth more than all the real estate in the entire state of California. The Nikkei hits 38,921 on January 4, 1990. Stock price-to-earnings ratios are 80 times earnings. Dividend yields are 0.38%. Nomura Securities predicts the Nikkei will hit 80,000 by 1995. It's euphoria. It's unstoppable. It's the exact same trap as the Edo period. Let me show you how. Here's what was happening beneath the surface. The Bank of Japan was creating money. Massive amounts of money. Why? Because in 1985, something called the Plaza Accord happened. The US and Japan agreed to weaken the dollar and strengthen the yen to reduce US trade deficits. The yen surged. Japanese exports became more expensive. The economy slowed. So the Bank of Japan did what the Tokugawa Shogunate did in 1695. They flooded the system with money. Interest rates went to near zero. Banks were given window guidance, quotas for how much they had to lend. Here's economist Paul Krugman explaining it. Japan's banks lent more with less regard for quality of the borrower than anyone else's. In doing so, they helped inflate the bubble economy to grotesque proportions. Sound familiar? Forced lending. Easy money. No regard for quality. The result? Land prices rose 167% between 1985 and 1990. Stock prices doubled between 1987 and 1989. But here's the critical detail. Risk was socialized in Japan far more than in the West. The government essentially guaranteed that banks wouldn't fail. Do you see it? The same pattern as Edo. Government creates easy money, forces lending guarantees there will be no consequences. Bubble inflates to grotesque proportions. On Christmas Day, 1989, a new governor took charge at the Bank of Japan. He raised interest rates. 4 days later, January 4, 1990, the Nikkei peaked at 38,921. By January 31st, it had fallen 2,000 points. By December 28, 1990, it closed at 23,849. Down 43% in 1 year. By August 19, 1992, it had collapsed to 14,338, down 63% from the peak. But stocks were just the beginning. Real estate crashed even harder. Land values in Tokyo fell 19% in 1991, then another 13% in 1992. By 2001, land prices were down 70% from their peak. Prime properties in Tokyo's financial districts had slumped to less than 1% of their peak. Let me repeat that. 1%. A property worth $100 million in 1990 was worth $1 million by 2004. Tens of trillions of dollars vanished. Banks were left holding mountains of bad debt. Insurance companies were insolvent. The economy ground to a halt. From 1991 to 2003, the Japanese economy grew at only 1.14% per year, while other developed nations grew at 3 to 4%. They called it the lost decade. But it wasn't a decade. It's been 35 years, and it's still not over, because they never fixed the underlying problem. They just did what the Edo Shogunate did. They created more money, lowered rates more, added more debt. The pattern continued, which brings us to right now, January 2026. Let me walk you through what's happening this week. Not theoretical, not historical. This week, Monday, January 19th, 2026. Prime Minister Sanai Takaichi announces a snap election. Her platform? Cut the 8% sales tax on food to zero. $115 billion stimulus package. Massive government spending increases. How will she pay for it? She doesn't say. Tuesday, January 20th, 2026. The bond market revolts. The 40-year Japanese government bond yield rockets to 4.213%, the highest level since it was introduced in 2007. The 30-year yield surges 30 basis points in one day to 3.9%, a move that Bloomberg says should take weeks, sometimes months. The 20-year yield jumps 22 basis points to 3.47%. The 10-year yield hits 2.38%, the highest since 1999. Bloomberg describes it as the most chaotic trading day in years. Traders are stunned. PIMCO fund manager Pramil Dawin says, a quarter-point surge in yields in a single session. Let that sink in. But here's where it gets truly terrifying. Because this isn't just about Japan anymore. Japan's debt-to-GDP ratio is 240%, the highest in the developed world. Government debt, 1,341.7 trillion yen, which equals $9 trillion US dollars. Annual budget for 2026, 122.3 trillion yen, a new record. And with yields spiking, debt service costs are exploding. But the real crisis is this. Japan's 4 largest life insurance companies are sitting on $60 billion in unrealized losses on their bond holdings. 4 times higher than last year. Do you understand what that means? These insurance companies hold massive amounts of government bonds. As yields rise, bond prices fall. Their assets are evaporating. And here's the data. Japan Securities Dealers Association showed that local insurers dumped a record 822.4 billion yen. That's $5.21 billion of bonds with original maturities over 10 years in December. The biggest net sale in Bloomberg-compiled records back to 2004. They're selling, desperately, to cover losses. And when they sell, yields rise more, which creates more losses, which forces more selling. It's a death spiral. The exact same death spiral that destroyed the Edo Shogunate in the 1830s. The exact same spiral that created the lost decades in the 1990s. But this time, there's no reset button. Here's why this matters to you. Even if you don't live in Japan. Japan holds $1.2 trillion in US Treasury bonds. They are the single largest foreign holder of American government debt. As Japanese yields rise, Japanese investors ask themselves, why should I invest in US bonds at 4.6% when I can get Japanese bonds at 4.2% with no currency risk? The answer is, they won't. They're going to sell. Hundreds of billions of dollars in U.S. Treasuries are going to flood the market. U.S. Treasury Secretary Scott Bessent was asked about this at the World Economic Forum in Davos. His response? I've been in touch with my counterpart in Japan. I'm sure they will begin saying things that will calm markets down. Saying things, not fixing the problem. Not implementing solutions, just saying reassuring things. That's panic. That's the financial equivalent of thoughts and prayers. And it gets worse, because this is already spreading. On January 20th and 21st, bond yields spiked globally. US 30-year Treasury, up to 4.93%, approaching the critical 5% level. German 30-year bonds, 3.5%, French, Italian, Swiss, Australian bonds, all spiking. Ken Griffin, founder of Citadel, one of the largest hedge funds on earth, just issued a warning. Bonds lose what makes them special in a portfolio when bonds and stocks move together in prices. Bonds lose a substantial part of what makes them so special in constructing a portfolio. Translation: your hedge is gone. The traditional 60-40 portfolio, 60% stocks, 40% bonds, doesn't work anymore. When government debt is in crisis, stocks go down and bonds go down together. You're not diversified. You're just exposed everywhere. So let me show you the pattern. The pattern that's been repeating for 300 years. Stage 1. The crisis, Edo 1716. Government debt crisis. Economy stalling, Japan 1985. Plaza Accord. Export economy threatened, Japan 2020. COVID pandemic. Economy contracting. Stage 2. The solution, Edo 1695 to 1716. Debase currency. Create more coins, Japan 1990 to 2008. Zero interest rates. Quantitative easing, Japan 2020 to 2024. Negative rates. Yield curve control. Unlimited bond buying. Stage 3. The bubble, Edo 1680s to 1700s. Jinroku era wealth explosion, Japan 1985 to 1989. Asset price bubble, Nikkei to 38,921. Japan 2023 to 2024. Stock market rallies. Takaichi trade. Stage 4. The inflation, Edo 1710s. Prices spike from currency debasement, Japan 1990s early. Brief inflation before deflation, Japan 2021 to 2026. CPI above 2% target for 4 years straight. Stage 5. The trap, Edo 1714. Try to reverse money printing, economy crashes, Japan 1989 to 1990. Raise rates, everything collapses, Japan 2024 to 2025. Finally raise rates after 30 years, bond yields explode. Stage 6. The desperate endgame, Edo 1830s. Force merchants to lend, never repay, fragmented currencies, Japan 1990 to 2020. Zombie banks, stimulus after stimulus, debt to 240%, Japan 2026. Propose massive unfunded spending, bond market revolts. Do you see it? The exact same sequence. Every time. Create money, then bubble forms, then inflation hits, then they try to fix it, then the trap closes, then desperate measures, then the system breaks. The Edo Shogunate collapsed in 1868 after 260 years of this cycle. Japan in the 1990s triggered the lost decades, 35 years and counting. And now, in 2026, we're watching the final act. Japanese bond yields at 30-year highs. Insurance companies hemorrhaging billions. Global markets convulsing. And governments have no tools left. They've already done zero rates, negative rates, unlimited bond buying, yield curve control. There's nothing left in the toolkit. The Bank of Japan meeting on Friday, January 24th, held rates steady at 0.75%. They're paralyzed, trapped between raising rates, which explodes bond prices, and cutting rates, which kills the yen and imports inflation. There is no good option, only different flavors of catastrophe. And the terrifying truth? This isn't just Japan's problem anymore. Europe faces the same debt trap. The US is on the same path. China is hiding the same problems. Every major economy has chosen the same solution the Edo Shogunate chose in 1695. Print money. Worry about consequences later. But there's always a reckoning. Always. The shogunate fell. The 1990 bubble burst. And 2026 might be when the entire global system finally learns what Japan has known for 300 years. You cannot print your way out of a debt crisis. You can only delay the collapse. And the longer you delay it, the worse it gets. January 2026. The pattern never dies. The question isn't if it will break. The question is, are you ready when it does?